What about retirement? As an entrepreneur, as a business owner, because I'm actively making moves in this area, I thought it would be fun to give you a behind the scenes look. Generational wealth is the thing, as it should be, because it's so important. It's the mindset of purchasing assets, right? Starting with a bigger snowball, using our gifts and talents to create entrepreneurial income. Hey, Courtney Sanders here. Welcome back to my podcast. And in today's episode, I want to talk about a question I get asked a lot, but was a little reluctant to, talk about because this is something that I'm still working out myself and something that I'm still building. But because I'm actively making moves in this area, I thought it would be fun to give you a behind the scenes look. And that question is, what about retirement? As an entrepreneur, as a business owner, how are you, saving for retirement? How do you build generational wealth for the next generation? I know that that's something very popular to talk about, especially on Instagram and YouTube. Generational wealth is the thing, as it should be, because it's so important. And I think many of us are waking up to the fact that not having generational wealth and having to kind of start from scratch, many of us didn't come from wealthy backgrounds, don't come from trust funds. We are now recognizing how much of a leg up you often have, even just for basic things. For instance, if you don't have to pay for your first house, right? If your parents have saved up or at least a down payment for you, if you don't have to pay for your college education or what have you, right? I kind of have no excuse. I had a full ride engineering scholarship and I lost it after I tried to start a business and failed. My first business, which was a hair care business. And I talk about that in plenty of other videos. So I shouldn't have had to graduate with college debt, but I did because I ended up having to work to pay my way through school. But my husband and I, for the most part, we paid cash for our wedding. My parents gave us some money, but we had to cover a lot. We had to save for our first down payment. So I'm grateful that we have accelerated our pace and are now building generational wealth for our kids so that they won't have to do that. And then, of course, saving up for retirement. But it was definitely something that we had to actively work towards, and it wasn't something that we were born with. And I know many of you who are either listening to this on the audio version of this podcast on iTunes and Spotify or are watching this on YouTube are in the same boat. So I just wanted to give that disclaimer. This is not like a CPA type discussion, right? I am not a CPA. I am not an accountant. You'll need to talk with your own accountant, your own tax professional, your own financial planner. This is not investment advice. This is just simply a casual, chatty discussion. If you took me out to brunch and you're like, girl, I see you making moves. What are you doing with your money? I just want to know what you were doing. This is essentially what I would tell you and what I'm talking about. So for me, I push entrepreneurship. Even if you love your job, even if you want to stay in corporate America, I still believe that you should have some entrepreneurial pursuits or some entrepreneurial endeavors, because having a business really helps you kind of grow your wealth and even get to retirement a lot faster than solely relying on just a traditional 9-to-5 job. And I was really amazed by this because when I was working in corporate America, I actually worked for the federal government and banking and finance, and we had really good benefits, right? Everybody was like, ooh, good government job, good government benefits. No one wanted to leave. And I just thought it was kind of crazy. Fun fact, the agency that I worked for, I got to come in through a student program where they were recruiting directly from undergrad. And then we were in a 3-year leadership program. And then after that 3-year leadership program, we had a guaranteed promotion into what our official role would be. And we had guaranteed employment. And so because my agency staffed up really heavily during the first economic crisis, right? The first recession, not the first recession in US history, but the housing recession that happened in 2008, 2009, 2010, all of those things. They had staffed up, but they had staffed up on term contracts where a lot of the people who were coming in were only coming in for 2-year terms, 4-year terms, 6-year terms, etc. And so I thought it was kind of nuts that people who were on those limited terms, 2, 4, 6 years, were actually re-enrolling in undergrad. And I'm talking about people who were in, like established, right? Who already had college degrees, who, were middle-aged, who had kids who might've been in college. They were re-enrolling in undergrad, like different undergrad programs, not because they wanted another degree or because they felt that they needed it for their job, but they were trying to like work a loophole where they could essentially come in the same student program that I was recruited through and then hopefully get one of those, guaranteed paid positions, even though they would be making a lot less than what they were currently making for 3 years until they got that guaranteed promotion. So I tell you that because that's the environment I came from, and that's how much people were obsessed with this idea of like benefits and retirement, and they just didn't want to give it up. I thought it was crazy. I was like, look, if your term is not renewed, like why not just get a different job? You could stay in the same industry, maybe go work for a bank or something. But they were like, no, I'm not letting go of these government benefits. So that's when I started to think about retirement, and I kind of looked at like the grown-ups, right? Because I was, mid-20s at that time coming out of college. So I looked at my older coworkers like, what is this that they are so obsessed with? And one of the benefits that we had was a 10% 401k match. And so everybody just was like raved about that. And they were on me. They were like, Courtney, no matter what you do, make sure that you are giving them the max to, your 401k. And I did, I believe them. I think it's good advice. It's great advice. If you're working in corporate America and your company is going to give you a match, like you should totally do that. But I think about fast forward when I finally, put in my 2 weeks and they were like, what are you going to do? You're quitting this like great job. You have a guaranteed position, like crazy girl. What are you doing? I know they were very skeptical about me kind of striking out on my own, especially this coaching thing. And they're like, you're so young. Like, they're like, oh, we're not going to burst her bubble, but poor girl. I know they were kind of like shaking their heads behind the scenes, but I know they were like, what are you going to do about retirement? And I just remember I had saved up all year. I had, been doing the max match 10%. And at the time, my husband and I went to sign on with a financial advisor. We no longer work with that financial advisor and actually didn't do much with them. We just kind of like parked our money with them. But I remember like fast forward, say 3 or 4 years after I was full-time in my business, reaching back out to that advisor to say, hey, the money we parked with you, we haven't done anything with it. We're no longer going to use your services. We need to transfer that, money out. And I just remember being amazed that I think it was in my Roth IRA. It was like $5,000 or something like that. And I was like, wait a minute. I remember like I had saved all year. Listening to everybody like, yes, I want to get the match. And in a year, I had only saved $5,000. And I say only, I don't mean to poo-poo that because I know there's a lot of people who are like, man, struggling to save that. But I'm like, that's part of the problem, right? And I think that is where we get a lot of our misconceptions about retirement and even benefits in general. I know a lot of people who are like reluctant to start a business because they're like, what am I going to do about health insurance? And I'm like, you'll do the exact same thing your employer does. You'll pay for it. You'll pay for a plan and you'll pay for yourself and your employees if you choose to have them. Like, that's the point of making a business. You're going to earn a lot more revenue than what you are making as an employee. And so when I looked at like those old statements, when that financial advisor, sent all that to us and I was looking at my IRA, I was amazed because fast forward, a few years with me being in my business, I remember I had put like $100K into my brokerage account in 1 year simply by growing my business and doing all the things that I talk about here on this YouTube channel. So anyway, I say that that's a long-winded way to say that my first principle when it comes to retirement as an entrepreneur is understanding that the beauty of entrepreneurship is that it's going to allow you to start with a bigger snowball, right? We've all seen those tables where it's like, okay, if you do the max match at your 401k at your job and you save from 35 to 65 in 30 years, you'll have this much set aside, right? But they're going off of relatively small amounts that they're assuming that you're going to save in the grand scheme of things, because that's the thing when you work a 9-to-5 job and it's the only source of income that you have, which is why I preach about having entrepreneurial endeavors, even if you love your full-time job and you want to keep it, because having all of your expenses, again, saving for retirement, building generational wealth for your children, having all of that try to come out of just like one salary it doesn't matter how much you make. Like, it's going to be difficult to do that unless you have an extraordinarily high income as an employee. But for the average person, by the time they pay their mortgage, rent, car note, pay off student loans, groceries, all these different things, there's not going to be that much left over to put towards retirement or to put towards generational wealth. So yes, all of those tables are correct, that if you take that relatively small amount, and again, it compounds over time for 30 years, sure, you're going to end up with $1 million or $2 million or whatever the tables show you in order to retire. But I find it fascinating that no one questions the amount that's being saved, right? It's just like, oh yeah, of course I would save $5,000 a year. Maybe if you make $50,000 a year, $5,000 a year is a lot. That's 10% of your salary. Even if you make $100,000 a year, that's 5% of your salary. So you're thinking, okay, I'm gonna, save this much for the entire year. But imagine if you had a successful business and you could put $100,000 away a year towards your retirement, right? How much quicker could you retire? I mean, just being honest, it wouldn't take you 30 years, right? I know for me personally, both my husband and I'm looking to not retire, like, I'll stop doing these videos or stop my business, but I want to be in a place financially, in terms of financially free, where I could retire this decade, right? So by the time we get into, what are we in 2023, right? By the time we get into the 2030s, I want to be in a financial place where I can retire because of what my assets are doing and the things that I've invested in, which we'll get into in just a second. So I would say shifting your mindset, just as you got to shift your mindset from the benefits conversation. No, I can't quit my job because my job provides benefits. Right. When you start your own business, you're going to be your own job and you're going to be providing your own benefits. So don't let that be a reason not to leave. And then same thing with your retirement. You're essentially going to fund your own retirement through your business profits, which leads me to the next great benefit of being an entrepreneur from a retirement standpoint, is that even from a tax advantage standpoint, and obviously I'm speaking from being a US citizen, so our laws and the IRS are what they are, and maybe if you're watching this from a different country, your laws are going to be different. And again, I'm not a CPA or an accountant. This is just high level things that I know in having conversations with my accountant. But as an employee, and as I'm recording this in 2023, I think the max that you can contribute to an IRA is like $6,500. Again, $6,500. That's the max that you can contribute, that the government allows you to contribute and to get that tax advantage, which in the grand scheme of things is not that much. And I'm not saying that you shouldn't do it. If that's the position that you're in, do it, and then see again how you can increase your earning capacity through entrepreneurship so that you can contribute more. But even when we talk about tax advantage accounts and IRAs, there's a SEP IRA, SEP, where it's really for self-employed people and entrepreneurs. You can open up a SEP IRA and the government allows you to sock away, as of this year, I think it's up to $66,000 in your IRA, and that's pre-tax money. Right? So even you see the big difference between, okay, I'm going to work this job and the max that I'm allowed to contribute to my retirement in a actual like tax advantage retirement account is $6,500. But if I become my own boss and start my own business, I can essentially contribute 10 times that much with pre-tax dollars, with like my actual business revenue, and I can throw that into a SEP IRA and I'm not going to be taxed on it. Like, again, the snowball is bigger. Just think about the difference of contributing to your retirement $66,000 a year, maxing that out, versus being an employee and contributing $6,500 a year. Again, not poo-pooing it if that's where you're starting, like do it, right? When I was, working a 9-to-5 job, I listened to everybody and I maxed out my 401k, and I'm glad that I did, right? I still have that money, but I'm so much further ahead because I'm able to use my business profits to contribute to my retirement. When you're an entrepreneur and you own your own business, there's just so many different things that are available to you that will allow you to accelerate your retirement, because again, you're starting with a bigger snowball, right? It's not $6,500 a year. Just in terms of tax advantage, IRA accounts, now we're talking $66,000 a year. So the focus is if you can get your revenue to support that, you can stock a lot away for retirement, which is really great. And speaking of, pre-tax, post-tax dollars, another cool thing that you can do that I'm looking to do this year when it comes to building generational wealth is that you can actually employ your kids, and the money that you save for them can come from your business, and it's essentially tax-free because you're not going to get taxed on it because you're paying your kids. So theoretically, your kids will get taxed on it. But if your kids are young, the way my kids are, then they're going to fall below that threshold, and they're not going to pay taxes at the end of the year. In fact, I forget how much. I think it's under like $13,000 or $12,900. Again, speak to your own CPA. There's a certain amount, but if they make under a certain amount, they don't even have to file a tax return, right? So what you can do is use those business profits, pay your kids. Now your kids actually have to do something for your business, and I'll talk about some different ideas of things that they can do in just a moment, but you pay your kids, and then the money that your kids get paid, and of course you're the adult, you're the custodian, you're setting up all of the accounts. My kids have accounts that I have set up for them. You can then use the money that you pay them to then invest in their future, whether it's you want to invest in their own IRA. I actually have UTMA accounts for my kids as UTMA, Uniform Transfer Minors Act, something. We'll put it in the descriptions of like exactly what it stands for, but it's essentially like a custodial type trust account that you are creating for the benefit of, the minors that you are in charge of. And you can use that for their college education in the future, or there's lots of different things that you can do for it. And there's a lot of really great tax advantages. And then of course, if you combine that with your business, again, you're paying for it with business profits, not necessarily your take home pay from your job. Now, essentially you're supercharging the amount of money that you were able to pass down to your kids, because now it's not post-tax dollars, right? It's pre-tax dollars. We forget, we get so obsessed with like, I need to get paid every 2 weeks and what's my paycheck? We're forgetting that what we are receiving in our account is actually after taxes, right? Your employer takes out all the taxes. So then you take that money and now you try to save for your kids' college fund, or now you try to invest for their future. You're actually dealing with less dollars to do that. However, if you're a business owner and you're using your business profits to then pay them, and then because they're making under a certain amount, they're not going to be taxed on it, you can then take the money that you've essentially paid them through your company and then put them in an UTMA account or different things in order to help, build wealth for their future. Now, another thing that I'm doing, which I'm learning more about, I feel like I have to do a whole podcast on this. Maybe I'll see if my broker wants to come on and talk about it, because she could speak way more about this in depth. But also you can take advantage of life insurance policies. And I know life insurance policies are kind of like controversial because, for years we've heard from people like Dave Ramsey that's like, no, don't do a whole life insurance, only do term insurance, and all of these things. And I believe that for a really long time. I have term insurance policies, and that's something that I focus on. However, if you get the right whole life insurance policy and it's structured correctly, and I want to emphasize that because real life insurance is not something that you can just buy off the shelf, right? You just don't go to a company and say, hey, give me one of those, right? Term insurance, you can do that, but whole life insurance, you want to be very specific. And so with insurance, there's things called riders, which are like additional like addendums that go into your contract that are like little rules about different things that you can do with the policies. And so the benefit of life insurance is that it could be kind of like a Swiss Army knife, in that, yes, it's life insurance that in the, unfortunate event that you pass before your time, you don't get to live out all your days, right? Knock on wood, Lord, I'm trying to live to 100, right? So I don't want to see my life insurance policy cash out until I'm 100. But most of us think that that's all life insurance is for, and it's not. Again, you can save in a life insurance policy and that money grows tax-free. So, the life insurance company invests the money and gives you guaranteed dividends, right? And there's a whole discussion. Again, I feel like I need a whole nother podcast, because some people are going to be like, well, why would I invest in a life insurance policy when I can invest in the stock market and I can get greater returns? And you're right. On average, maybe the stock market might do 10% or 12%, where with a life insurance policy, maybe you're going to get guaranteed returns of 6%, right? So it's lower. But again, the key term is guaranteed. And in the stock market, there's a lot of ups and downs. So yes, over time, maybe it averages out to 10% or 12%. But what happens if you just so happen to be retiring at a time when the stock market is crashing? Then that's kind of like null and void. So one of the great things about, again, these properly structured whole life policies, don't just run out and buy one. You'll have to speak with a broker who can do the riders the right way. But one benefit in how this works for both retirement and generational wealth building is that you can borrow against the policy. So essentially, you can sock however much money you want. It's got to be structured a certain way, and there's something called MEC limits. And I'm saying this for the people who are in the profession, who are like watching and are probably like, hey, we make sure you say all these things. This is not a podcast about the specifics of life insurance policy, but high level to explain it. For the most part, if it's structured correctly and you're working with a good broker who understands all of these things, for the most part, you're going to be able to sock away a lot of money inside of the policy. And so you're like, well, what do I do? Like, I want to use it, obviously, before I die. Yes, you can. One of the ways that you can use it is by borrowing against the policy. And so the beauty of that is when you borrow against the policy, the money that you borrowed is not deducted from what is compounding, right? So let's say you have $100,000 in cash value inside of your policy, and that is what is, building up, and you're getting your dividends every year. And you take a loan of $10,000 against your life insurance policy. Well, if it were just a normal bank account or even the stock market, if you take $10,000 out, all you have is $90,000 left. So that $90,000 is essentially what would be compounding, but not the full $100,000. In a life insurance policy, the full $100,000 is what compounds, as if you never even took the $10,000 out. And I know you're like, well, what happens if you don't pay it back? Well, if you don't pay it back, when you die, hopefully when you're 100 years old, they just deduct that loan from your death benefit. And again, there's ways to do it, and it's not just you take all this money out and then the policy collapse. Like, there's ways to do it, but for the most part, that's one of the really great benefits of this. And so for me, yes, I am paying my kids, and then I am putting that money in UTMA accounts so that, when they turn, I think in Texas it's 21, they'll have access to it. We can use it to pay for education. But I'm also putting money away in life insurance policies for my kids so that when they get older and they become of age, if they want to buy their first car, purchase a home, do whatever, instead of pulling that money out of whatever, the stock market or savings account or wherever we have it, they can just take a loan from themselves against their own life insurance policy and pay themselves back the same way they would pay a bank back or anybody else back, right? If you bought a car and you didn't pay cash for it and you have a car note, chances are you are paying the lender who loaned you money for that car. You pay them faithfully every single month and you don't even think about it. You just pay your car note, right? Again, we do this to banks, we do this to other companies, but we don't do it to ourselves. How amazing would it be? And I'm like, oh man, imagine if my parents had set this up for me, but how amazing would it be if by the time your child is 16, let's say you are a new parent, you just had a kid, and you start doing this strategy and you start saving money inside of a life insurance policy, imagine how amazing it would be if by the time that kid is 16, they can actually just borrow against their own life insurance policy, however much money, $20,000 or whatever, in order to purchase that car, and then they pay their own policy back, right? And then, it's teaching them discipline and paying things back and all of this. And sure, they pay interest to themselves, but it's all going back to their own policy. And this is something that they can tap into over the course of their entire life. So when they're 16, they can do it for their first car. When it's time to pay for education, you as a parent can borrow against that policy to actually, pay their education. And, you could choose to pay that back or have them pay it back when they get a job. That way they're not paying Sally Mae back. When they want to get a down payment on their home, again, they can pull from that policy or borrow against it and then pay themselves back. So it's really a beautiful thing. In fact, if you want to get super aggressive with it, you can borrow against your own policy and then go invest in the stock market. So, you got to know what you're doing in order to do that. But I have some very well-to-do friends who are pretty savvy who do things like that, where they will borrow against their policy because they know that money is going to get a guaranteed, 5%, 6%, is going to get whatever it's going to get on its own. And then they throw it in the stock market when the stock market is down. They wait a year or two until the stock market rebounds, and then they're making all this returns, and then they cash out of the stock market, pay their life insurance policy back, and it's like they got 6% and 12 or 20% or whatever it was in the stock market for that time. So it's really cool. There's a lot of different strategic things that you can do. But again, going back to being an entrepreneur, again, you can use your business to pay for your life insurance policy. So you can either have a personal policy and use just, the dividends that you would pay yourself to pay for it, or you can get key man life insurance, right? So just as we think of big Fortune 500 companies have life insurance policies on all of their executives, because they're like, look, if something happens to you, our business is going to take a hit as we have to find someone else who can do your role. They have life insurance policies out on their executives. Your business can have a life insurance policy out on you. And therefore, again, it's now your business's revenue is paying for that policy, and you're not technically even paying for it out of pocket, but you still get the benefit of being able to borrow against it in a business sense, maybe to go invest in things. So maybe there is something that you want to invest in for your business, or some project that you want to take on. Your business now owns a life insurance policy against you, the CEO, and your business can borrow against that in order to invest and grow the business, and again, do all of these amazing things. So life insurance is a really cool tool for both generational wealth building and retirement, because as you near retirement age and you've socked all this money away in the life insurance policy, and maybe you've even used that money over time, and you borrowed against it to invest in other things. Maybe you borrowed against it to go purchase a short-term rental property or an Airbnb, and then you use that money to pay off the loan. And so now you've got this like property over here, and you still got your life insurance policy. Like, you can use it to secure the assets essentially that you need for your retirement. But if you want to actually use your policy in retirement, you can do that. So as you get to retirement age, if you want to start drawing down on your own life insurance policy, again, maybe you take loans against it. When you die, all of that is just going to be netted out from your death benefit anyway. So, provided that you have put enough in the policy on its own, you can actually just pull that down, and that just becomes retirement income. So it's super cool. It's like your own bank, basically your own like savings account or bank. It's a generational wealth building tool. And it becomes a retirement tool for you as well. And again, I feel like I'm getting ahead of myself. I'll probably have to do like a whole nother podcast just on generational wealth. But another key feature that you can do is that life insurance policy, you don't make the beneficiary your kids, you make the beneficiary your trust, right? So when you die, all of that goes into the trust, and then your kids then become the trustee, and it becomes for the benefit for their kids. And then it becomes this like snowball thing down the line where everybody has life insurance policies. You do, your kids do, your grandkids do, and all of those policies pay out into the trust. And so you look up, and 4 and 5 generations from now, there's this big snowball of money that your whole family can borrow against for all of the things that we need in life, whether, paying for a wedding or down payment on a home or whatever. Again, now you've created a trust fund essentially for your family in 2 generations, and you use your business to do that, and got really great tax advantage savings with that as well. So many different things that you can do with your business when you think about retirement. And the last thing I'll say about retirement, and really just a perspective that I have as an entrepreneur, is that I understand that it is my job to buy cash flowing assets, essentially. So beyond, I know there's a lot of rules around like taxes and retirement accounts, and it can seem very technical, right? But again, if you're a business owner, you have a greater advantage because you can contribute more to a SEP IRA versus like just a normal individual IRA as an employee. Also, you have advantages because you can play around with life insurance, your business can own it, you can pay your kids, and your kids can pay for their own life insurance policies, like tax advantages. There's a lot of different cool things that you can do with all these different accounts and different structures. But the main thing that I like to think of is that it is my job that while I am healthy and I can actively work in my business, that I take some of those profits and I put it towards assets that can passively work for me for the time when I'm not able to actively work in my business. And that's what I do. Even as I am recording this in an investment property that I purchased cash using the profits for my business. And again, purchasing this property lowered my, my tax liability at the end of the year. So that was a benefit. But now I have this property that even within a year has already started to appreciate. And then on top of that, I use it as a short-term rental. So I receive, short-term rental income on it. And I use it for my content recording. It's kind of like my de facto production studio. I create a lot of my courses in here. And so now I'm able to generate profits from my course. I get a very small residual income from YouTube. YouTube doesn't pay me much, but I get about $1,500 a month from my YouTube videos, where even if I stopped recording videos, a lot of that money is coming from videos that are just in existence. So as long as those videos don't, get taken down, or, YouTube doesn't remove my videos, that's essentially residual income that I am getting from this property because I record here, right? And then I'm also getting residual income from the short-term rentals and all of these different things. So that is my thing. I'm just like, all right, let's focus on this business. Let me do the best that I can. And then at the end of the year, let me look at my profits and what can I put those profits in terms of assets that are going to take care of me when I'm old and gray, even though I think I'll still be sprightly and healthy. I can't wait till I have a full head of gray hair. Side note, I think women with gray hair are beautiful. I'm super nervous though, because I don't want the in-between, right? I want my hair to either look like this or be like fully gray, right? So that kind of like in-between, I don't know how I'm gonna feel about that, but I hope that I'm still fly, even when I'm quote unquote old and gray, and I expect to be very healthy. Just had some green juice today. So, take care of myself, really prioritize health, all of those things. But yeah, the name of the game essentially is to buy assets, right? You ever wonder why you don't hear ultra wealthy people talk about retirement accounts a lot, right? You never hear, I don't know, Bill Gates or some, Jeff Bezos. Like, you never will hear them talk about like, oh, my IRA account or whatever. One, again, because those limits are too low. So there's only so much that you can put in them. But they know that over time, they have been using the profits that they get from their business to buy all types of assets, whether it's real estate, and it's not just, residential real estate like what I have here, but even commercial real estate, buying buildings, buying real estate all over the world. Bill Gates just bought up a bunch of farmlands, right? We don't think of farmland as residual income, but it is. If you purchase a farm and there's a farmer on it and they're working the land for you and then selling whatever, the corn and all that stuff, the profits that you're making, that could be residual for you as well. Obviously we know about stocks and bonds and investing in the stock market, but we forget that there's all kinds of assets that you can get into that really become available for you once you get to a certain level in your business. There's artwork, that's something that I'm starting to learn more about, but getting into the art world and purchasing art that appreciates. You even see, wealthy people buying luxury watches and things. You typically wouldn't think of that as like, oh, for retirement, but certain watches, again, if you can keep it secure, a lot of them have them in different safes in different countries and they don't even wear them. But that could be a substantial asset that you can then draw down on or essentially sell it in the future for your retirement. And not that I learned this, but I read about this in a book by Bethany Frankel. So maybe you remember Bethany Frankel from Real Housewives of New York. She has the Skinny Girl Margarita brand and she sold it to Jim Beam for like $1 gazillion. And she's got this personal brand. She has a book called Business is Personal that I thought was really good. And I loved how she talked about her strategy was investing in up and coming companies, investing in apps, and kind of being a silent partner and getting the residual income from that. So that's a part of her retirement. She also flips houses on the side. So she talked about how she bought a house either in like the Hamptons or Martha's Vineyard or something, fixed it up, and then flipped it in about 18 months during the pandemic. And she too buys luxury watches. She watches the luxury watch market, and when certain watches come on, men's watches, she'll buy them, hold on to them, and then flip them essentially when their market goes sky high. So I've noticed that a lot of really, really wealthy people for their retirement, they're like, what assets can I get my hands on? Preferably assets that are going to give me cash flow, whether it's like, again, a rental property or a commercial building or a farmland or something that's going to produce income for me while I own it. But even if they don't purchase cash flow producing assets, they still will produce assets that they expect to appreciate in a reasonable amount of time. And they don't wait. They'll cash out when it hits a high level and they'll kind of take their chips and run and sock it away and then do it over and over again, so that by the time they get to retirement age, they have more than enough to support them. And so I think that's the main message of retirement and entrepreneurship is getting to the point where you have amassed enough assets that the cash flow that comes off from those assets, or the value of those assets if you need to sell them, is worth more than enough to see you through in retirement, right? So it's not just about how can I max out a particular tax advantage account, which even though, if that's the position that you're in right now, working a job, like absolutely do it. But the goal should be to get to a place where you have enough entrepreneurial income, even if you're working a full-time job. Yes, you can do it. I have a friend who's pretty high up in corporate America, and she has a whole consulting business on the side. Her company knows about it. They hired her when she had it. They were like, you're so talented, we don't even care. Like, just, keep it separate or whatever, but we're totally fine with you doing it. And she makes as much or more in her side consulting consulting business that she does in her current, full-time job. And she uses that side consulting income, again, to purchase Airbnbs and do all the things that I'm talking to you about, because that is going to be her retirement, right? So it's not just retirement accounts. We got to get out of this mindset. It's the mindset of purchasing assets, right? Starting with a bigger snowball, using our gifts and talents to create entrepreneurial income, and then purchasing assets that are ultimately going to create passive income for you. So that's all I got to say on this topic for now. If you want to know more about generational wealth, if you're curious about the life insurance thing, let me know in the comments. If you're watching this on YouTube, or if you're listening to this on wherever, iTunes or Spotify, you can send me a message on Instagram, and I'll see if I can get my broker on my very own podcast. But yeah, that is how I think about retirement and building generational wealth as an entrepreneur. I hope it was helpful for you and that you run out and do the same. If you love these topics, you love talking about financial freedom, you'll probably love my financial freedom workshop. This is a video that I did not too long ago where I break down the mindset that you need to have in order to get to a place where you can begin creating financial freedom. So if you're interested in that, you can click the link in the description box or the show notes, depending on where you are watching or listening to this from. And with that, I'll see you in the next episode. Bye.